Welcome to the Resilient Advisor Podcast. This episode is part of the Advisor Growth Series. My name is Jay Coulter, and my partner in this series is Jay Hummel of the Wealth Advisor Growth Network. Jay, for folks watching us on video, where are you?
Pretty cool today. I'm in the boardroom at the New York Stock Exchange. You're my buddy Clint Sorensen and Wealth Shield. And we do a lot of work with Crane Shares, and so they opened the market this morning. They rang the bell, and so I'm here hanging out with those guys.
The architecture, for podcast listeners, you can't see this. The architecture in that boardroom looks just amazing.
Oh, it's pretty cool. Obviously, growing up as a student of finance, it's a once-in-a-lifetime opportunity to sit here. So I'm glad we get to tape it from here.
I know, it's perfect. So tell me about the Crane Shares offering that launched today.
Yeah, so Crane Shares is John Crane founded the company. Very interesting story. Went to China years ago. Ended up launching a media company. He opened China to U2, the Rolling Stones. He opened the Chinese market in the media space, and he ended up selling that company. And he came back to the U.S. and ultimately understood how to invest in China. So he launched a ETF company that focuses on investing in China. So they're one of the leading providers of ETFs in the Chinese market.
And so today they launched a new ETF. What index is it based on?
They're doing it. It's based on the Chinese index. It's basically a manufacturer, broad-based Chinese index. They actually didn't launch a new one today. They just happened to be open in the market today because they wanted to tell the story about the company.
Got it. I'll put links to Crane Shares in the podcast notes. Jay, let's talk about the big news this week, and that is Schwab's potential acquisition of TD Ameritrade. It's going to have implications. All the talking heads have been out the last 24 hours giving their opinion. What do you say?
Oh, I mean, I think it's really interesting. I think it's smart. I mean, it's gonna actually add to their banking capabilities. And as you and I have talked, as advisors need to add more services, I think it'll add to the banking capabilities of Schwab. Obviously, it's going to take out a choice. So, in some ways, now RIAs have one less potential partner on the custodian side. But I've always been a Schwab fan. Was a Schwab client. Ran my RIA in Schwab. So I think in the end, I think for the RIA market, it's going to be a good thing because it's going to add to the banking capabilities of Schwab.
Yeah, I agree. So I'm a client of Schwab. My RIA's custodian is TD, both great platforms. I don't see how this hurts the advisors in any way. And along with Schwab reducing their, eliminating trading costs, it just adds to a better client value proposition. I think the real challenge is going to come for the asset managers because now Schwab has even more power, which again will benefit the end client, but the pressure that will put on fees for all of these products is really, really going to make for compelling value propositions.
Yeah, I wouldn't want to be an asset manager, as we've talked about in today's market. It's really tough unless you're one of the major players. The margin compression, fee compression is going to continue, and I think this acquisition is only going to spur more discussion around that topic.
Yeah, I haven't run across too many firms that are using some of the other smaller custodians that would be potential acquisition targets now. Really, it's going to leave Schwab, Fidelity, and Pershing. Do you see any other players in the space that are acquisition targets for the picking right now, or are they're going to die?
I think they're going to die. I mean, I don't see any other major player that anybody's going to buy. And so you're down to the big three.
And the real loser, E-Trade. I mean, their value proposition of helping retail investors buy and sell stocks for a commission is gone. I mean,
it's gone.
Yeah.
I mean, it's why we've talked about before. I would never run a business where my sole proposition is we're cheaper. I just think at the end of the day, somebody's always going to be bigger. Someone's always going to be cheaper. And I think that's a value proposition that's a mess. And on the advisory side, you and I see firms that do that. It's just this is just another example of if your number one proposition is we're cheaper, you eventually lose.
Yeah, that's right. And really, the big takeaway is the closer you are to the client, the better. And that could be more true now than in this business. And gosh, the first half of the next decade, you got to get there quickly.
Got to get there quickly.
Yeah. So Schwab Impact was 2 weeks ago. We didn't get a chance to debrief that yet. What was your experience like at Impact this year?
Oh, I think it's an amazing event. But I think one of the things that we've talked about on this podcast that rings true is you walk into that place, it's overwhelming. I mean, the vendor hall is just unbelievable. And it's great from the sense that there's all these vendors now that can provide a myriad of services to the RIA. But at the same time, if I'm an advisor walking in there, I'm absolutely overwhelmed, and trying to figure out who you do business with is an absolute distraction. And so I think this whole concept of RAs outsourcing more, accessing vendor management capabilities is a key. And I mean, that vendor hall is just absolutely overwhelming.
I can imagine. I tell you, I find advisors reaching out to me on a regular basis to ask about the next shiny new object, especially in the fintech space. And that's just them sitting in their offices. I can't imagine that exhibit hall and the overwhelming feeling that they had. Tell me about the asset managers that were there, and where do you see that business headed as it relates to their relationship?
Why, I worry about it. And we started the podcast here. I just think there's a lot of asset managers when you walk through that hall. I've been at an asset manager, they do great work, but that business is just becoming such a commodity. And what I'm concerned about is that you fast forward 10 years from now and half those booths won't be there. And you think about where we are in distribution in today's world, just standing at a booth, handing out stress balls, and is that the distribution marketplace of the future? And I just, I'm concerned for that vendor hall. I just think it's a tough space to be in, and unfortunately, I think half of those people that we saw this year at Impact won't be around 10 years from now.
Yeah, I completely agree. I've shared this on another podcast about a month and a half ago. I went to Michael Kitzis's XY Planning Network conference last summer.
Yeah,
And
sure.
Jay, there were 0 asset managers in the exhibit hall. So I think the future's pretty clear there. And I hate it for them. I worked for an asset manager for a long time.
Yeah, create a lot of value, but it's a tough market. And the people who own the shelves, Schwab, as we talked about, are going to do the right thing by the end client, which is great. But that means prices are coming down. It's going to be a hard business to be in.
Yeah. And you and I had talked about previously the proliferation of CRM vendors at these events, both the old stalwarts and the new startups. CRM decisions are very, very challenging for advisors. Do you have any takeaways from Impact as it relates to CRM vendors in particular?
Well, and my opinion, I'm a little contrarian on this. I feel like there's too much focus on CRM, and we've talked it is every business sits there and they say, well, their CRM's as good as their processes are. And there's so many firms, and I saw it. You see all these advisors sitting in these CRM demos, getting themselves all worked up about process workflow. And you go ask them how many clients they have. Well, they have 120 clients, and they spend 60% of their employee time and the advisor time trying to get their CRM right. And you could run it on an Excel spreadsheet, frankly, if you really needed to. So I just think, CRM continues to dominate. It dominated the vendor hall at Impact. It dominated the sessions. I just think it's in many firms, it's a meaningless distraction to spend as much time as firms are spending on it.
So you and I have a difference of opinion as it relates to CRMs with inside of an advisory practice. But what I have found, to your point about most of these businesses could be run in an Excel spreadsheet, the advisors that would build that Excel spreadsheet still wouldn't execute on it. They won't execute in a CRM. They won't execute in an Excel spreadsheet. I wish we could repackage CRMs as operating systems, because I think you get more buy-in from the firm. It makes it easier to delegate tasks. But where I think the biggest problem comes is from what you just talked about. The shiny new CRM that's supposed to make your life easier isn't really going to do it if you won't execute. Pick a really simple one, which typically is not Salesforce. Stick with it for the long term. You've got data-rich tools at your disposal, and it can really have an impact. But
don't customize it. Just because we've talked about before, just because you can do something doesn't mean it's a good idea. And you add all these fields, and I'm going to customize it, and boy, my CRM is going to make me different and unique and all these things. And you take something like Salesforce, which is brilliant off the shelf, and you've created a complete problem 3 to 5 years from now when you have to unwind all the customization decisions that you made. So, you and I go round and round on CRM, but I just think people are way distracted by it, and it just, to me, in some ways, it's very, very unnecessary.
Awesome. Well, Jay, thanks for taking time while you're sitting there inside of the New York Stock Exchange to come on. Really, we're getting great feedback on this series, so I appreciate your continued participation.
Well, thanks for having me, Jay.
The information provided is for educational and informational purposes only and does not constitute investment advice and should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult an attorney or tax advisor. Resilient Wealth LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Resilient Wealth and its representatives are properly licensed or exempt from licensure. For Resilient Wealth information, please visit Investment Advisor's public disclosure website at www.advisorinfo.sec.gov by searching Resilient Wealth CRD number 301986.